Welcome to today's video, where we address the 7.75% debt trap and why eliminating high-interest variable rate debt like a HELOC can be the single most guaranteed return available to you right now. We will move step by step through the math, the capital gains question, and a practical action plan. Let's begin with what makes 7.75% so dangerous, and then we'll move into how to neutralize it quickly. Here's our roadmap for the session. First, we'll outline why 7.75% variable rate debt is a serious threat. Next, we'll explain why paying it off provides a guaranteed, tax-free return. Then, we'll tackle the capital gains issue that often stops investors from acting. After that, we'll compare liquidation versus aggressive paydown. We'll follow with a practical step-by-step plan and a case study. Finally, we'll test your knowledge with quick quizzes and end with key takeaways and a summary. Let's start with the danger of 7.75%. A 7.75% HELOC on $70,000 costs about $5,400 each year purely in interest. That is a guaranteed outflow of cash. Because the rate is variable, the risk is not just present, it is ongoing. That exposure can grow if rates rise again. With that, let's transition to why paying this off can feel like earning a guaranteed return. Eliminating a 7.75% HELOC is mathematically equivalent to earning a guaranteed, tax-free return of roughly 7.75%. On $70,000, that's about $5,400 per year you stop paying. In monthly terms, you free roughly $450 in cash flow. It's extremely difficult to find investments offering that type of risk-free, after-tax return consistently. This is not about timing the market. It's about removing a guaranteed drag. Next, let's visualize how much of your outflow is interest when you delay action. Delaying payoff means interest costs continue to accrue. At high variable rates, minimum payments often barely reduce principals, keeping you trapped longer. By eliminating the interest drain earlier, you improve your monthly cash flow sooner, which then compounds your overall financial flexibility. Now, many investors hesitate due to capital gains taxes. Let's clarify how those actually work. Capital gains tax is assessed on the gain, not the entire sale amount. If you sell $70,000 of securities with a $50,000 cost basis, the gain is $20,000. At a 15% long-term capital gains rate, the tax is approximately $3,000, which is often less than 1 year of interest on a $70,000 HELOC at 7.75%. If the basis is $20,000, the gain is $50,000, and at 15%, the tax is about $7,500. While that is larger, eliminating a high, variable rate burden can still be financially superior over multiple years, especially considering risk and cash flow. Next, we will compare liquidation versus aggressive paydown. On the left, liquidation provides a guaranteed return equal to the interest rate, immediate cash flow improvement, and removes variable rate risk. It's efficient when selling non-core holdings or assets already flagged for rebalancing. On the right, aggressive paydown avoids the immediate tax event but requires strong and consistent cash allocation. During paydown, you continue to incur high interest costs and remain exposed to rate changes. Now let's translate this into a practical step-by-step plan. First, identify non-core or overweight portfolio positions. Second, calculate potential gains and taxes using your cost basis records. Third, prioritize selling assets that fit your rebalancing goals, or where you have losses that can offset gains. Fourth, execute a targeted liquidation large enough to extinguish the $70,000 HELOC. If you must avoid a tax event, then allocate an aggressive portion of your monthly income to the HELOC until it is fully repaid. Automate transfers and set reminders to ensure consistency. Finally, once the debt is gone, rebuild your emergency fund and resume or increase investment contributions. Next, we'll put some numbers in a quick table of scenarios. This table illustrates 3 scenarios. In the first, selling $70,000 with a $50,000 basis yields a gain of $20,000 and an estimated long-term capital gains tax of $3,000 at 15%, which is less than 1 year of interest at 7.75%. In the second, with a $35,000 basis, the tax is $5,250, very close to 1 year of interest. In the third, with a 20,000 basis, the tax is 7,500, higher than 1 year of interest, but the payoff eliminates multiple years of variable rate risk and restores cash flow immediately. Now, let's test your understanding with a quick quiz. Question: paying off a 7.75% HELOC is most similar to which type of return? Options: A. A risky 7.75% market return. B. A guaranteed, tax-free approximately 7.75% return. C. A guaranteed, taxable 7.75% return. D. A variable return between 0% and 7.75%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Paying off a 7.75% HELOC effectively locks in a risk-free, after-tax return equal to the interest rate. Now, let's move to another common misconception about capital gains. Question: when you sell $70,000 of appreciated stock, capital gains tax is typically applied to what? Options: A. The entire $70,000. B. Only the gain portion. C. Only the basis. D. The HELOC balance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Capital gains tax is applied to the gain, which is the sale price minus your cost basis, not the entire amount sold. Next, let's map the decision visually to cement the strategy. This mind map lays out the two primary strategies: liquidating assets or pursuing an aggressive paydown, and the associated benefits, including a guaranteed return, lower risk, and improved cash flow, along with considerations such as capital gains taxes, portfolio rebalancing, and maintaining an adequate emergency fund. Now, let's walk through a concrete case study so you can see the numbers in context. In this case study, you begin with $70,000 at 7.75%. Annual interest is approximately $5,425, or about $452 per month. If you liquidate appropriate assets and pay off the HELOC now, that interest stops immediately, and your monthly cash flow improves by roughly $450. If you instead allocate $2,000 per month to pay it down, the balance in interest will decline, but you will still incur significant interest during the payoff period. As the timeline shows, rates have been volatile, so delaying keeps you exposed. Next, we will briefly cover an important disclaimer. This content is educational and not tax, legal, or investment advice. Your situation may differ, and tax rules vary by jurisdiction and personal circumstances. Interest rates change over time. Consult a qualified professional and run your own numbers before taking action. With that in mind, let's capture the key takeaways. High-interest variable rate debt represents a guaranteed drain on wealth. Paying it off yields a risk-free, after-tax return that is difficult to match. Capital gains taxes apply to profits, not the full sale amount, and are often smaller than the interest you would otherwise keep paying. Eliminate the debt swiftly by liquidating non-core assets or by committing to an aggressive paydown. The resulting free cash flow increases your resilience and your capacity to invest productively. Finally, let's summarize and close out. To summarize, a 7.75% HELOC on $70,000 costs roughly $5,400 per year. Paying it off is equivalent to earning a guaranteed, after-tax return of about 7.75%. Capital gains tax applies only to the gain, not to the entire sale amount, and is often smaller than the interest you would pay by delaying. The mathematically superior path is to liquidate non-core assets and eliminate the HELOC immediately. Alternatively, commit to an aggressive monthly payoff schedule. As we close, I have a quick creative request for you. Thank you for watching. If this video clarified your decision, please like, share, and subscribe. I'd love to hear your approach in the comments. Are you liquidating now or committing to an aggressive paydown? Your insights may help someone else take action. See you in the next video.